Today, I'm going to be sharing with you guys one of the best documented and highest performing trading strategies in 2022. I just took a trade earlier this week using this strategy, and it has me in a $3,000 positive P&L here on the US dollar versus the Norwegian krone. All right, pretty interesting stuff. Let's roll the intro.
New to the channel? What's up? My name is Cleveland, and I worked as a professional trader and analyst for 6 years. And now I'm here to bring you my daily insights on business, capital markets, finance, and more. Enjoy the video and welcome to the channel.
What's going on, guys? Welcome back to the channel. If you guys are new here, welcome. My name is Cleveland. I like to do fundamental research in markets. Today, we're going to be talking about event-driven trading strategies, one of the best documented trading strategies in the history of capital markets, and it has been performing extremely well because market conditions this year and for the foreseeable future are perfectly adjusted to this particular methodology. All right, so before we get started, make sure you guys are subscribed to the channel, and if you're enjoying this video along the way, like the video for your boy. I very much appreciate it. All right, so I created a nice presentation here for you guys. Event-driven trading strategies is what we use over at Top Traders. We've been trading this same methodology for almost 6 years now, and it has not proven us wrong, right? And there's many reasons why. Let's get into it. All right, so you guys can see the subtext here: improve your trading performance by trading world events, not in the way that you think though. A lot of people think it deals with the economic calendar. We're about to disprove that right now. And please, guys, make sure you guys read the risk disclaimer here. Past results do not indicate future results. All right, make sure you guys are trading safe. All right, so first and foremost, event-driven strategy basics. Okay, you guys can see here my fiance, this was actually in 2020. She was trading a little bit of a coronavirus event pandemonium. It was quite fun, but long story short, event-driven strategies aim to exploit any special situation in asset fundamentals. This may affect the valuation of a tradable asset. Okay, it's a little bit jargony, but don't worry, we'll get into it. All right, key points: looking for mid to long-term perceived changes in asset fundamental values. A lot of people think that when you're trading events that you're going off of the economic calendar and you're hoping that as soon as the event comes out, you're able to put that buy in because CPI was positive and higher than expected. And so now you're going to start buying up the Australian dollar. No, that's not how that actually works. This is not how event-driven strategies work. So you're going to see that it almost has nothing to do with the economic calendar, not to be used with short-term volatility methodologies. Again, for people who want to trade event-driven strategies and who think that when you trade event-driven strategies or trade the news, so to speak, that you're mostly doing that based off of, again, these short bursts of volatility or parabolic moves, that is not the case. All right, invest in events that are not well understood or anticipated by the market. This is one of the key points to trading this strategy profitably. We have a bunch of examples to show you guys. All right, so I want to get a quick excerpt here from John Jackson. This Mercer, this is a massive building here in my city, here in Atlanta. Mercer is a multinational asset management fund, and they manage billions and billions and billions, tens of billions of dollars under management, and they use event-driven trading methodologies in certain sectors in their portfolios, right? And here, John Jackson, head of diversifying alternative research, he mentioned often the outcomes of identified events are less market dependent, with the event or catalyst being the primary mechanism for value creation. The net potential benefits of incorporating event strategies are quite powerful, as outcomes can be countercyclical to the economic cycle with often low correlation to the broad market. Broadly, event-driven results have been mostly positive over the trailing 5 calendar years and year to date. Okay, basically what he's saying there is when the market's going up and everybody's getting the same returns, you can utilize event-driven trading strategies to capitalize and catapult you to more earnings than your peers. Okay, so that's very important. Let's look at some great examples here. All right, so the Russian invasion of Ukraine. I oftentimes mention this one here on the channel because way back when in February, before Russia actually ended up invading Ukraine, we knew that this was going to be an event that catalyzed the euro to sell off. And you guys can pause the video here and kind of read through this. But more than anything, when Russia invaded Ukraine, global markets were very fearful that that was going to expand into the region. And certain euro countries were going to start to have to participate in that war. And that started to tank the euro sell side. This was a pretty easy trade to get in on. This is one of the awesome examples as to why event-driven trading strategies are so cool, is because you have a clear understanding, a clear catalyst as to what it means to actually engage in this particular market opportunity. Unlike 99 of what most of the retail guys talk about on their different channels, they're oftentimes mentioning very obscure, not very well thought out trading strategies that they say work just because, right? The moving line crosses over and then you're supposed to do this or that. That doesn't make sense. You can't bet big money on those type of trading opportunities. And it's hard for me to argue that, right? A lot of the stuff that retail traders do is conspiratorial, where they're looking at Ichimoku clouds or they're looking at a specific candlestick pattern. And when you say, why does it work? They say it just does. Or they'll say market geometry. That can't give you a true edge in markets. But understanding things to this capacity, we all can understand this. Every single person watching this video can understand that if Russia invades Ukraine, the euro could sell. It's not rocket science, but most retail traders aren't paying attention to things this clear, right? And we have some other key catalysts here like global market risk sentiment, politics, and economic data. So not every single asset move is going to be isolated to one event. There could be a multitude of events that start to have an asset price sell off. Here's another awesome example. Japan's central bank refusing to raise rates during an interest rate hike. So I'm going to actually read this one out because it's so interesting. During the worst inflationary period in the modern era, 6 out of 7 reserve currencies raced to continuously raise their interest rate levels to stifle inflation. The sole economy to refuse to raise rates and maintain a negative 0.1 interest rate was the Japanese economy, right? This move scared most market participants to sell the yen, driving it to its lowest levels in 40 years. Again, not rocket science. If we're seeing every single economy in the G7 raise rates, even till this day, we just had Canada raise rates this morning. Okay, guys, everyone's raising rates. The only country that isn't is Japan. And that's why we saw this explosive buy side run here on the USD JPY. But you could have traded this on anything correlated to the Japanese yen, not just the currency pairs. There's some even US stocks that are highly correlated to the Japanese yen where you could have got exposure to this particular market calamity. All right. So another variable that hurt the Japanese yen was commodity prices. Since Japan is such a net importer, right? They have to import almost all their goods. They don't have many natural resources. When commodity prices start to peak, you oftentimes start to see the Japanese yen weaken. And of course, supply chain issues as well can correlate with certain things in that capacity. Okay, moving on. Canadian dollar spikes due to the Russian conflict. So this takes us back to another catalyst via the Russian conflict, but this was in an entirely different reason here, right? The Canadian dollar had this massive buy side run. So 10% of the Canadian dollar's foreign exchange earnings come from oil, right? And so when Russia ended up having all those sanctions earlier this year, many of the EU countries basically had to find a new oil seller, and many of them went to Canada. So you saw a massive explosion here on the Canadian dollar. Now, guys, I'm not just showing you guys these trades in theory. Again, we have mostly documented inside of our community or here on my YouTube channel, me talking about these trades and taking them. And then also I'm about to show you guys here a USD Norwegian krone trade that deals with exactly what we're talking about here today. But again, there's a lot of correlation between oil and the Canadian dollar. This was another event risk trade that worked out extremely well. And of course, you guys can see here, learn to trade world events over at toptrader.io. We have a free training called Becoming a Trader. I want you guys to go check that out. It's free. Link is in the bio. It's going to basically give you guys the foundation, 5 principles that you can use to basically start to execute in this capacity. So that's going to be in the bio there below. All right. Make sure you guys check that out. So lastly, we're in this trade right now. Monetary policy slowdown drives market buying, right? And it's so cool to start to use this type of terminology because when you're at a office party, or well, nobody's in the office anymore, when you're at a coffee shop or when you're talking to your friends, and you can really talk business here. You can really talk about markets from a very intellectual point of view. Trust me, it's going to give you some browning points, and it oftentimes can get you some cool business opportunities as well. But let's read this out. The 3-month yield is now above the 10-year yield. That's often a recessionary signal because it means the bond market is reflecting lower inflation and economic demand in the long term, partly caused by higher inflation and rates in the short term. The market, however, accepts that a recession is highly possible. At this point, it just wants to know that the end of the central bank policy tightening is in sight. And that's what we're seeing. Many market participants are theorizing right now that we're about to slow down this interest rate rising excursion that we've been on for the past couple of months. And many people think that that's going to be indicative of basically things calming down and really the economy coming to a point at which we see a light at the end of the tunnel, so to speak. We may get to a point to where we just have higher interest rates. We are basically curing all inflationary worries, and the market and the economy had a soft landing. So people are actually buying up the Norwegian krone based off of this idea right now. And you guys can see right now we're still in a 3,171.93 cent profit on this trade sell side at the moment. So we've been monitoring this trade, and we took this trade inside of our community. We mentioned it on October 21st that we were inside of a US dollar Norwegian krone short. And so far since then, we've had nothing but sell side. All right. So event-driven trading strategies, man, oh boy, if you guys can really understand them to a high capacity, you will get a lot of benefit in the short term and in the long term. All right. So wrapping it up, what are the pros? For a retail trader, event-driven trading strategies provide immense clarity as to when, why, and how to take advantage of a market opportunity. No longer do you guys have to be confused about the technical entry, the confluence, all of the crap that the retail trading industry kind of spouts as the way to do it. You don't have to worry about any of that because that's not how the professionals do it. I've worked at financial institutions and none of them operate in that capacity. Only here on the internet, when people are in their houses trying to figure out how to navigate capital markets, are they coming up with these strange ideas about how to do so. Leave those people out of it. Leave them alone. You do not want to coalesce with these individuals. They oftentimes do not know what the hell they're talking about. Meanwhile, you have CFAs, chartered financial advisors, you have professional money managers, you have people with career experience managing tens of millions, if not billions of dollars, telling you guys the strategies that they use to manage that money. Those are the people that you should be listening to, not the tweenies and the lifestyle gurus here on the internet. All right. So couple of key pros, the Kelly criterion. The Kelly criterion states that during heightened times of probability, you can start to increase your bet size. So when you have a fundamental catalyst that you deem as favorable, as likely to happen, like the Ukrainian war, there was a reason why that was the biggest trade of my career. It was because of the Kelly criterion. There was a very likely outcome that the Russians were going to invade Ukraine. So we put on more capital than we elsewise would have. All right. This is what you can get when you trade event-driven trading strategies. So, of course, that creates a larger profit potential there. You have a clear catalyst. You know exactly why you're getting in the trade. There's no guesswork about it. You'll know also if the trade doesn't work out, you'll actually also know exactly why it doesn't work out. Most of the times people lose trades, they have no real idea. They blame it on maybe their risk management or their stops were too tight. And that could be the case. But at the end of the day, if you don't have a clear reason as to why you're getting in the trade, who knows? All right. And then your trade management is going to be key. It's going to be amazing. Why? Because you're going to be able to monitor the trade based on the catalyst itself. You're not monitoring the trade just based on the chart and being freaked out if you get a pullback. You're monitoring the trade based on the catalyst. If the catalyst is still perpetuating itself in the actual market environment, then you're still in the trade. But if you get information from the market, from the media, from doing your own research, that particular trade is about to unwind, i.e. Russia is leaving Ukraine and everything's going to be better, then yeah, maybe you shouldn't continue to sell the euro, right? So that's exactly what I mean when it comes to trade management. There are cons. It's not all sunny in Philadelphia, all right? There's lots of slippage oftentimes. If you're trying to execute quickly on these trades, then yeah, for sure, you can wind up putting yourself in a position where maybe the pricing that you expected to get wasn't ideal. Okay, that can happen. Oftentimes, you're also profiting off of disastrous situations. I know a lot of people don't care about that, but I just maybe have too strong of a moral compass. At the end of the day, I'm still taking the trade anyway, so who really knows? But this is the case. And if you guys don't want to, potentially engage in certain economic situations that are negative for potentially millions of people, then this particular trading strategy may not be for you. You maybe want to stick to value investing. Research-oriented traders only. You can't just throw open the laptop, log onto your trading view, and start doing your technical analysis. Again, most of those guys never scale past a few grand in their account and usually end up blowing it. There's a reason why there's a 90-90-90 rule. 90% of traders lose 90% of their capital in 90 days. That's for retail traders, mainly because they're just gambling on TradingView. You guys want to know how to do research if you're going to trade this methodology, and most traders don't want to ever learn how to do research, so usually this methodology isn't going to be for them. They're trying to take the easy way out. But if you want to do research, we have an entire methodology on how you can do research profitably. Yeah, the link is in the bio. Take a look at becoming a trader, and you'll be able to apply that research knowledge to trading this strategy profitably. Difficulty planning. This is also a negative here, because at the end of the day, if you wake up and there's like this random thing that has happened in capital markets, then yeah, it's going to be a little bit difficult for you to kind of, figure out exactly how you want to attack that situation. So you usually need experience, going through the process with this strategy. It's not going to just work right off the bat. Sometimes it can, and that can make you kind of feel like you're on cloud nine, because some of the situations are just so obvious. It's like, well, take the trade and then you make money and you're like, well, that was easy. Well, it's like, yeah, well, the event played out the way you thought it would, so you made the money, right? But sometimes it can be difficult planning around those trades. So maybe you don't get the best entries, or maybe you don't get the best maximization of profits, but that's just going to be something that you're going to deal with until you become a more sufficient and better trader. That's an experience problem more than it is a, quality of methodology problem. All right. So guys, event-driven trading strategies are extremely powerful. They are very well documented. Many multinational, multi-asset firms use them on a day-to-day basis, and I implore retail traders to take a look at it, pick it up, and see what you can do in a simulated account first. Do not trade this with live capital until you really know what it is that you're doing. All right. If you guys need some help in learning how to trade event-driven trading strategies, go check out Becoming a Trader, where you can learn the 5 principles you must know to profit in capital markets using this methodology. That's me back when I was trading at the firm, Loma Management Partners. I used to have all my screens up, and I would come home and try to do the best research I could to go back to the company and say, hey guys, this is all the stuff I learned. And I was literally looking every day, every week for market catalyst that I really felt like could drive certain assets, to the moon or sell side, and it was an amazing experience. And actually seeing some of those research reports that I put out there go into the firm and then be traded was amazing. And then eventually being able to actually have my own desk and manage money as well, it just showed me full circle that, hey, this methodology works. Outside of the money, me kind of moving up in the career as well was like even more indicative of like me seeing success. It was quite interesting of an experience. So guys, if you have any questions, let me know. All right, this isn't your typical retail trader strategy with the technicals and the woo-has and the engulfing bearish patterns and all that stuff. What you guys will realize is, the candlestick pattern doesn't really matter. We're looking at very profound, substantial structural breaks. That's what kind of helps us identify when we need to get in the market or not. The market really lets you know what to do in terms of when to get in, when to get out. You don't need all the trickery to figure that out. All right, there's a lot that goes into this stuff. If you guys, again, have any questions, let me know. Excited to bring this guys to you. Hope to talk soon. All right, peace out.